often triggers audits for independent contractors like realtors.
So what you have to be careful of is taking excessive deductions that you do not have support for, and you do have to be careful that you're picking up all of your income. So for example, for realtors, if you receive commissions from property management and commissions from sales of homes, you want to make sure that you're picking up both 1099s on your return, because if not, it could trigger a correspondence audit with the IRS.
Oh wow. Hello everyone, this is Sharon Abel with eXp Realty, your Sussex County agent. And today I'm here with Tammy. Thank you so much for having me.
Thank you.
And I just have a couple of questions for you.
Sure.
So I can educate you that you're watching. So, when does it actually make sense for a realtor to move from sole proprietor to LLC or S Corp in Delaware? And when is actually a waste of money?
That is a good question, and I get asked that all the time from agents, because when you first start out in business, you're structured as a sole proprietor, and then you have a decision to make if you want to get further protection and become a limited liability company, or do you want to convert that limited liability company or LLC to a subchapter S corporation. And really it has to do with several factors. Volume of revenue. It also has to do with the fact if you have employees or are you just the sole owner and operator of your entity. So commonly, if you're the sole owner and operator of your entity, then you would more than likely stay in the space of being self-employed or a single member LLC. Now, if you have a team or you have several employees that are producing revenue for you also, then you could look at forming a subchapter S. Now, there are costs in forming a subchapter S. You do have to administer payroll, and you as the owner operator must put yourself on a fair and reasonable salary. You also have to keep your books and records such that you can do a separately filed tax return with commonly the data that you would have on a balance sheet and a profit and loss. Whereas if you stay a sole proprietor or a single member LLC, then you file on your personal tax return that you would file anyways. So it really depends on a lot of factors of whether it makes sense to go from a sole proprietor to a subchapter S corporation.
Awesome. And what is the big tax mistake new realtors make in their first year that costs them a lot?
Yeah, well, there are some definite pitfalls when you're first starting out. So you're excited, you're in business, you're trying to get yourself out there, your name out there in the community. And so sometimes we forget about the foundations of record keeping. So establishing that solid record keeping from the start is really important, because later, if you don't, it's going to cost you a lot of time. It's hard to reconstruct records several months after the transaction. And it could also cost you some money, because if you're not keeping good books and records and you forget about deductions, then you may lose those deductions. So that is one of the common pitfalls I see, is that business owners that are new don't always start with organizational records from the start.
And what's the difference between tax preparation and tax strategy?
Oh, that's something I love to talk about. Yeah, so tax preparation is really just once a year compliance work. It's being a historian, not being proactive. Tax strategy is being proactive. It's taking a look at that income, those expenses, making sure you're accounting for everything so that you're well advised and you can make decisions about your business timely.
And how early a new agent start paying partly estimated taxes and even inconsistent income?
That's a great question. And this is what gets some new agents in trouble. So what you have to make sure you're doing is you're following the IRS's rules on paying your estimated tax payments. And just because you're in business doesn't mean that those rules didn't apply before. It's just that when people have employment, they often have the necessary taxes taken out of their paycheck. Well, now you may not have a paycheck. You're self-employed, so you take out just what are considered draws. So it's important to set aside some money for those draws and then comply with the necessary estimated tax payments that you must make. That's not voluntary, it's mandatory. And if you do not make them, the IRS's penalties and interest are quite high.
Wow, okay. what deductions are commonly missed by realtors working from home?
Oh yeah, definitely. So from home, we often see office in the home that's missed, and you have to use the space regularly and exclusively for your business. So you can't be just sitting at your dining room table. You actually need to have regular and exclusive space. Back in 2013, the IRS came up with a simplified method where you no longer have to depreciate your home and keep track of all the utilities. You can simply write off $5 a square foot up to $1,500. Now you can take the long method of calculating, but a lot of people don't like to do that because you are mandated to depreciate your home, and then later you have to recapture that as income even if you're excluded from a gain. So that catches a lot of realtors by surprise. So definitely educate yourself on the two different methods of taking your office in the home.
Awesome. And what percentage of cash of each commission check should we realistically be set aside for taxes?
Okay, there isn't an exact percentage, so you really have to consider what tax bracket you're in for both federal and state, and you also have to consider how much you're paying in self-employment tax, which is Social Security, and Medicare. So this isn't perfect, but what we like to tell a new realtor that's starting out is go ahead and set aside 30% of your commission check, and that will be a pretty good start. Now, we also don't recommend waiting until the end of the year to see if that's enough. Again, you want to be looking at your income and strategizing throughout the year to make sure that you aren't met with any tax surprises at tax filing time.
How long should realtors keep taxes and expenses records, and why?
The statute of limitations is 3 years, but it gets confused often because it's 3 years from the date that you file the return, not the year. So for example, we're filing right now for the 2025 year, but we won't be filing those returns until April of 2026 or even later if you have an extension. So it's not 3 years from 2025, which would be 28. It's actually 3 years from the date you filed. So with an extension, if you didn't file until October 15th of 26, the IRS would have 3 years from that date. So you would be well into 2029 that they could still open you up for audit.
And what happens if a realtor mixes personal and business finances too early?
Yeah, that is not advisable at all. So commingling of funds is something I would definitely avoid for several reasons. It makes it less efficient to do a tax return. It's hard to do planning if the business and the personal expenses and income need to be separated. And if you were to be audited, the IRS sees as an additional risk if you've commingled your funds. So it's best just to keep your business activity in a separate bank account and use a credit card that is not commingled with your personal activity.
Thank you, Tammy. This is wonderful. Thank you.
Yeah, thank you for having me. Thank you.
Wide open, heart steady, mind sharp.